So in the last month, the stock market has fallen harder and faster than Michael Spinks in the first round, and while investing in these turbulent times feels like a scary move, this is exactly what we dividend investors have been waiting for. All this red in the market is creating some great opportunities to swoop up some shares of your favorite dividend stocks at a discount, and in this video, I'll be sharing 4 dividend stocks that seem like particularly great buys as we head into the month of October. Starting with this first one, we are talking about HP, ticker symbol HPQ. Now, at the time of recording, shares of HPQ are down about 30% year to date, so a pretty steep drop, with most of those declines coming just in the last month, where they're down 20.6%. Now, if we zoom out over a longer period of time, just over the last year, we can see that HP had a nice little run up in share price heading into 2022, and for most of the year, they were pretty up and down and up and down, and it looks like the share price peaked right around the beginning of June at about $40 per share before making its steady decline down to where it's at now, just under $27 per share. And this calls into question what exactly happened with HP to make the share price drop from its high of $40 per share down to where it's at now. And from what I can tell, guys, there are a couple things going on here. Number one, all year, as many of you know, there's been lowered PC demand as consumers prioritize spending their money on other things, in addition to ongoing chip shortages, which is hurting companies like HP's ability to meet the remaining demand that's left over. And these two headwinds resulted in them missing their recent Q3 earnings estimates that they released last month. And with that, they also lowered guidance for the rest of the year, which did not help things, and this included an expected lower free cash flow return, and we're seeing this play out in real time. As you can see from this screenshot, year over year, their levered free cash flow is down over 62%, which is a pretty big drop, and it's had an impact on the compound annual growth rates for the free cash flow across the 3-year period, the 5-year period, and the 10-year period, so that's not looking too great. And when addressing all of this, HP's president and CEO Enrique Lores says, "We are taking clear actions to mitigate near-term market headwinds and further strengthen our business for the future." And then he goes on to say, "I'm confident in our ability to execute against our priorities to drive long-term sustainable growth and value creation." Now, on that note, in terms of creating value for shareholders, this is something that HP is doing in a couple of different ways. Number one, as you can see, this company is pretty aggressively buying back shares. And back in October 2012, about 10 years ago, they had just under 2 billion shares outstanding compared to the trailing 12 months, where they have just over 1 billion shares outstanding. So just in the last 10 years, they've bought back about 900 million shares, which is a pretty aggressive buyback rate. And this is great for shareholders because as they've reduced the number of shares outstanding, this increases shareholders' ownership of the company as a whole. And the second way HP is creating value for shareholders is with the dividend. Now, as you can see, the dividend stats are looking really nice. They have a forward yield of 3.67% with a very low payout ratio, about 22.7%, with plenty of room to grow, guys. And that's exactly what they're doing with the dividend. This is a high growth dividend stock, 13.5% for the 5-year dividend growth rate with 11 consecutive years of dividend growth. So there's a lot of good things to like about the dividend. Now, whether or not right now is a good time to buy HPQ is up for debate, but I think the valuation is looking really sweet. And as you can see, that forward PE ratio, you'd be hard-pressed to find a lower one. It's currently sitting at 6.68, which is about 62% lower than the sector median. So quite a steep discount compared to the rest of the sector. And this is also a pretty big discount compared to this company's 5-year average. Their 5-year average PE ratio is 9.46, and where it's at today is about 30% lower than that. So yeah, I'd say right now is looking like a pretty good time to buy some HPQ if we're just judging it off of the earnings multiple, which, you know, there's definitely more to look at, but just on the surface, it looks like a pretty good buy as we head into October. Now, moving on to stock number 2, we are sticking to the technology sector. We are going to be talking about Broadcom, ticker symbol AVGO. And despite this company's recent declines in share price, which we'll talk about in just a moment, it is still outperforming all of its competitors, companies like Intel, Qualcomm, Texas Instruments, AMD, and NVIDIA. As you can see in the last year, Broadcom is just barely hanging on to a positive share price performance compared to the rest of these stocks. We have Intel down about 45%, Qualcomm down about 6%, Texas Instruments down 14.5%, AMD down 25%, and NVIDIA down almost 38%. And while a lot of these companies have been having a hard time performing and putting up good numbers due to various macro and industry-specific headwinds, that does not at all seem to be the case with Broadcom. They are still putting up some really solid numbers. As you can see, guys, pretty much since the start of the pandemic, if we go all the way back to May 2020, every quarter since then, Broadcom has put up increased revenue. However, even despite this continued growth, shares of Broadcom are still on the decline, at least so far in 2020. 2022. Year to date, they are down about 24 1/3%, and in the last month, they are down a whopping almost 9% just in the last 30 days. On the valuation page here, we can see that their forward PE ratio is sitting at 13.43, which is not too bad. This is about 23.5% lower than the sector median, is just a hair lower than their 5-year average by about 7.3%. And the dividend stats are looking pretty great as well, specifically the growth, which we'll get to. But first, the forward dividend yield is sitting at 3.26%, not a bad yield with a payout ratio that's sitting near 47%. And now the growth rate, guys, take a look at that. Have you ever seen a higher 5-year growth rate? 34.82% with 10 years of consecutive dividend growth. So guys, it's looking like if you bought some Broadcom and just held onto it for a few years, your dividend income from this position is just going to skyrocket. That's crazy. And taking a look at this real quick, if the forward dividend yield is 3.26, 3 years from now, your yield on cost will be 5.5%. And then 5 years from now, just 2 years after that, your yield on cost is going to be over 6%. So that's pretty impressive. And that's exactly what can happen when you buy into these high growth dividend stocks like Broadcom. Now, stock number 3 is another one that's seeing some pretty substantial losses, guys. We are talking about the United Parcel Service, ticker symbol UPS. Now, we'll get to this company's share price performance in just a moment, guys. But before that, interestingly enough, the biggest catalyst I've seen for this company's drop in share price has nothing at all to do with UPS. We can actually point the finger at FedEx, who last Friday reported a pretty big earnings miss that sent their share price plummeting 21% just for the day, which seemed to have a residual effect on UPS. Now, as you can see, just in the last month, UPS is down over 13%. And if we zoom in right here to the last 5-day period where they're down about 6.5%, we can see that the drop off, this loss in share price happened right here. And this is the day that FedEx reported their earnings. So UPS was definitely affected by that, and they've traded pretty flat since then, leading up until today. Now, as far as the valuation, UPS is looking priced pretty well as we head into October. The forward PE ratio is sitting at 13.73, which is 10.5% lower than the sector median. So a nice little discount there. And this PE ratio is also about 20% lower than the company's 5-year average. So it's definitely trading at a discount compared to where it usually sits, which is fantastic. And I think right now is a pretty good time to buy with the holiday season quickly approaching us. I know it's still a couple of months away, but guys, it'll be here before we know it. And you know what happens during the holiday season? More purchases, more online purchases, which means more shipping, more deliveries. And companies like UPS are going to be responsible for making those deliveries. So they should benefit from the holiday season coming up. So definitely something to keep in mind as you're considering adding this to your portfolio or buying some more shares. But anyway, moving on, guys, and getting into the dividend stats. As you can see, the forward yield is not looking too shabby, 3.44% with a, pretty moderate payout ratio, just above 40%. And the 5-year growth rate, just like the last 2 stocks we've seen, is in the double digits, sitting at 11.28% with 12 years of consecutive dividend growth. All right, my friends, now getting into the 4th and final stock of the day, we're talking about one of my favorites. This is going to be Altria Group, ticker symbol MO, who is down about 10.5% year to date, with a lot of these losses coming just in the last 30 days, where they're down about 6.3%. We can see right here pretty much all of the losses in the last month came in this time period, which really coincides with Altria's ex-dividend date. And this drop from the ex-dividend date is something that we can expect to happen every single quarter. An article I read on Seeking Alpha said historically there's been a tendency for Altria shares to fall immediately after the stock goes ex-dividend, perhaps related to dividend capture strategies. And in case you've never heard of dividend capture, essentially what this is a tactic that some investors like to use where they'll buy a stock right before the ex-dividend date to capitalize and receive that dividend. Then they'll sell the stock immediately after the stock goes ex-dividend. So they basically lock in that dividend, sell the stock right after, and I guess enough investors are doing this with Altria Group that it's causing somewhat of a sell-off, which causes the share price to go down. I personally don't think dividend capture is a good long-term strategy. I actually really don't understand why people do it, but to each their own, guys. And this sell-off aside, there's actually been some really good news come out recently for Altria Group, which is surprising. We haven't seen a lot of good news around this company all year. As you can see, they recently reached a settlement in the 2-year-long Juul probe where the company was accused of marketing their products directly to minors, which is no bueno. And in this settlement, Juul Labs, which Altria Group is a stakeholder in the company, they will pay $438.5 million to more than 30 different states across the country to settle this 2-year probe over the marketing of its products. Diving a little bit deeper into this, the settlement will be paid out over a period of 6 to 10 years, and Juul has, as part of the agreement, agreed to refrain from youth marketing, paid product placement depicting anyone under the age of 35 in its marketing, and using cartoons, among several other factors. So basically, from here on out, in terms of Juul's marketing, they're going to be on a really short leash to ensure that they're marketing in an ethical way, at least as ethical as tobacco companies can go. Personally, guys, I'm just glad to see Altria Group and Juul be able to put this behind them, pay the settlement, and just move on, at least until the next piece of litigation comes, which I'm sure it'll happen, knock on wood. And I guess if nothing else, us dividend investors can still just sit here and capitalize on the nice discount that Altria is currently at. As you can see, the forward PE ratio is 8.75 there in the single digits, which is 53.7% lower than the sector median. So it's at quite a bit of a discount compared to the rest of the consumer staples sector. And this is also nearly 27% lower than the company's 5-year average PE ratio. So all across the board, Altria appears to be at a pretty nice discount. Now, getting into this company's dividend stats, you guys have heard me say this before, but Altria Group is a triple threat, guys. They have a really high forward dividend yield that is inching closer and closer to 9% as the share price keeps coming down. The payout ratio is a bit on the higher side, 76, almost 77%, but this is pretty normal for a company like this. They typically operate with a higher payout ratio, and they've got it down. They must have it down because they have 52 years of consecutive dividend growth, which is very impressive, and that's part 2 of the triple threat equation. Part 3 is that 5-year growth rate, sitting at 7.89%. And now that we've made our way through those 4 stocks, guys, I want to share with you a good handful more that appear to be at pretty nice discounts that I think you should definitely keep your eye on. Number 1, guys, we have Scott's Miracle-Gro, which just in the last month is down over 30%, a huge drop just in the last 30 days. And in the last year, guys, they are down nearly 63%. So this company has really come down in share price. The second stock to look out for is Simpson Manufacturing Company, ticker symbol SSD, which is down over 20% just in the last month. And if you take a look at this stock, guys, go and scroll down and check out this article right here by my friend Joel Batista. He wrote a really cool article on Simpson Manufacturing. Definitely worth a read if you want to learn more about this stock. Stock number 3 to look out for is a beaten down dividend king. We've got none other than 3M, who is down another 19% in the last 30 days, which brings them to a 34.4% year-to-date loss so far, and I would not be surprised if they kept going down in share price. The 4th stock to keep your eye on is Williams-Sonoma, which is down a whopping 15.8% just in the last 30 days, which makes up the bulk of their year-to-date loss of 18.5%. So definitely a nice discount to be found with this company right now, and as you can see on the right-hand side of the screen, they have a nice single-digit PE ratio of 8.09. Now moving on, you guys know I had to mention Intel. This is a stock that I personally have been adding to here and there over the last month, and in the last 30 days, they're down 17.3%. Very substantial drop. No surprise because this company just keeps heading south, which brings them to a year-to-date loss so far of about 44.7%. The next stock to look out for is Stanley Black & Decker, which is another beaten down dividend king, and in the last month, they're down 13.6%, which brings them to a year-to-date loss of over 53%. Oh my gosh. Next up, we have Whirlpool, ticker symbol WHR, who is down 13.7% in the last 30 days, and that brings them to a year-to-date loss of 36.72%. And this one also has a single-digit PE ratio, 6.42. Now, this next one might be the cheapest semiconductor company around right now, guys. This is Qualcomm, ticker symbol QCOM, who is down 14.7% in the last month, which brings them to a near 32% loss year-to-date. And out of all the semiconductor stocks, I think this is the only one with a single-digit PE ratio, officially sitting right under 10 at 9.98. Now, last but not least, I've been seeing a lot of you guys buy this one in the Discord group. We have T. Rowe Price, ticker symbol TRO, who is down about 11% in the last 30 days, which brings them to a year-to-date loss, pretty substantial, 41.5%. Anyway, now that you're clued in on some of the best, cheapest dividend stocks to buy right now, check out this next video to learn about how you can get dividend payments coming in every single week. That's right, guys. In this next video, I put together a portfolio of dividend stocks that will literally pay you every single week out of the year, and you guys know as well as I do, there is nothing better than when those dividends hit. So check it out right here, and I'll see you in the next one.